Well, another red day in the markets with today all the cap curve indices turning negative. In fact, the Nifty would have been even more negative than the 32 basis points if not for the gas related last hour of buying. And this again is a repeat of yesterday in the sense that FII+DII flows were again 4,000 crores positive, though driven by almost 4,000 from DIs alone and 400 crores from FIIs. So the seventh day that Nifty has had a losing streak. Very few times in the past have such a 7-day streaks lasted. The trigger points remain the same as yesterday. Brent crude with a geopolitical crisis showing no signs of solution, continuing to trend above today, crossed to 91 and trending high. In addition to which, global bond yields, because I think the US borrowings have stepped up in the US by the US government, and so that's driven a rise in yields across all the countries. Even Indian bond yields have gone up by to about 6.82 from about 6.75 a few days ago. So a slight bit of rupee weakening also accompanied this. So these two trigger factors have led, and I said today that yesterday at least there was a little bit of parity in terms of the Nifty selling to 1300 to 1700 if I remember right. Today it wasn't. There was a retail profit booking or panic, whatever you want to call it, because only 1,000 stocks went up, whereas 2,000 stocks went down. So what does this actually now mean? Now it means that, look, there is bottom fishing by FIIs to some extent, and DIs are supporting but unable to pull the market above. This 7 consecutive days of losing streak, right? I have done a detailed analysis of 7 and what has been the past history of such a 7-day streaks in terms of future returns. Do read my post on this both on YouTube, Facebook, LinkedIn, and those of you on my WhatsApp, I'll be sending that right up. But to briefly summarize, right, I think we are now approaching the period where domestically the earnings season, as I mentioned earlier, has been fairly decent with about 11 to 12% large cap profit growth, 22% mid cap profit growth, and 33% small cap profit growth. So the largest segments of the market are on a decent wicket. GDP growth, if $90 crude sustains, could be affected by about 30 basis points, but even then we'll still be at 6.2, 6.3 GDP growth. So there is really no concern, and we talked already about how the FII has proved to be a greater success. RBI is closing it earlier on 31st August. So with this situation then, with such a 7-day losing streak, I feel that it's now a time to step up and buy. Because history says that if you have such a 7-day streak, you have waited for a year after the 7-day streak, there's a 90% chance of a 16 to 20% return. So I think we are finally at a stage where I think that we can now start accumulating more amounts. Depending on your risk appetite, what you buy can vary, right? If you have high risk appetite, you can actually buy the crude related impacted sectors, because I don't see that the way the supply situation has been impacted by Hormuz, there's a lot of pent up demand will be, the pent up supply will be there. And I will feel that if you take a year down the road, oil should stabilize, and hence these sectors which have corrected a lot could bounce back. So if you have an aggressive risk appetite, tilt your portfolio towards rate sensitives plus crude sensitives. But if not, if you're of a more moderate risk appetite, I would suggest you put a little more focus on domestic facing consumption, capital goods cycle, and a little bit of banking and financial services in your portfolio. So a good time to now step up your buying, because such consecutive losing streaks have in the past proved to be a very good buying opportunity. Thank you.